Hey guys, welcome to my channel Easy Economics 67, wherein we are going to discuss a very important concept in the monetary policy, that is liquidity adjustment facility, LAF. In short, we'll call it LAF in this lecture. So let us understand this very important concept LAF today. First of all, introduction. Now what is LAF? This LAF, liquidity adjustment facility, it's a monetary policy that is used primarily by the central banks all over the world. That is, globally this policy is used. In India, it is used by RBI to manage the short term cash flows in the banking system. Now what does this LAF exactly does? It allows commercial banks and primary dealers to borrow money from the RBI during cash shortage, or even whenever these banks or institutions they have excess funds. At that time these institutions can park their excess funds with the RBI, and in return they get interest on their excess funds. So this is how basically LAF allows to borrow as well as lend the funds. This is how LAF works. Let us move into the concept in the deep concepts. First of all, core components. Now how do this LAF works? How does it function exactly? Let us see that. LAF helps central banks control inflation and maintain financial stability through two primary operations. There are two main operations involved in the working of this LAF. First one is repo rate, which is repurchase agreement. It is called repo rate. Now let us see the meaning of repo rate. Repo rate means it is the rate at which the RBI lends money to the banks against the eligible government securities, against the collateral. Borrowing under this repo, whenever the commercial banks they find that they are in shortage of funds, at that time they give their government securities, they lend their government securities to the RBI for getting loans from the RBI, and the interest rate at which they borrow from the RBI, that is called as repo rate. Currently the repo rate is 5.25%. Currently, the repo rate is 5.25%. Now, let us understand this concept of repo rate with an example, with some main example. Supposing, let us assume commercial bank is there, whichever commercial bank, let us say HDFC, or even for that matter consider SBI, State Bank of India. So this commercial bank, supposing they are facing some shortage of say temporary shortage of some funds, they are in need of funds, then in that case they borrow money from RBI to maintain their daily operations. Let us assume they need the loan amount of, let us say, 5 crores. Then in that case the bank borrows rupees 5 crore from the RBI, and for borrowing that 5 crore rupees the bank pledges the government security worth rupees 5 crore to the RBI. They are giving their securities to the RBI, they are pledging their security to the RBI, and say current repo rate, the interest rate is 5.25%. Then in that case, at the end of 1 year, the commercial bank must repay the principal amount, that is the amount of 5 crore, and plus whatever is the interest applied at 5.25 percentage interest rate. So the whole amount they have to repay to the RBI, and they will get back their security pledged with the RBI. That's how the repo rate works. I hope with this example the point is much more clear to you. The other is, second one is reverse repo rate operations. See, what is reverse repo rate? Repo rate means it is the excess funds with the commercial banks and institutions which they park with the RBI, and on that fund they get interest as income. See, let us see the meaning. The rate at which banks park their excess funds with the RBI, this absorbs the excess liquidity from the market, and which is useful to maintain financial stability in the Indian money market. So this is called as reverse repo rate. Now, but natural repo rate is higher as compared to the reverse repo rate. The current reverse repo rate is 3.35%. But it is good that instead of excess funds in the market, RBI absorbs that and pays interest to the bank, and bank can safely park their excess fund with the RBI. Now let us see the practical working of LAF. Daily basis, bank evaluate their cash requirements against their reserves, and if they feel that there is cash deficit, then they use the LAF window to raise short term capital. On the other hand, if there is excess fund, then they park those fund with the RBI and get some interest on it. So that's it for today, guys. It was very short, but I hope it helps.